unlike most real estate investments, when it's relative to other real estate, we had to show what, in essence, was an opportunity cost versus the basket of assets that the trust would otherwise invest in, which was unique to this, something we weren't used to.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. Today we're looking at a case study that highlights the importance of including US public equity REITs as part of an overall real estate investment strategy. I'm joined on the podcast by Brendan Cooper and Jared Morris, directors at Teacher Retirement System of Texas, to hear how they tactically invested in REITs and the opportunities it presented for the pension fund. Brendan, Jared, welcome to the podcast.
Thanks for having us.
Pleasure.
Can you give our listeners a brief overview of TRS and how perhaps it's set up compared with other pension plans?
Sure. So TRS represents all public educators in the state of Texas. We are roughly 200 billion, actually a little higher as of today. Although when we implemented the strategy, it was a bit lower. We have a 15% allocation to real estate. That can be either private or public, although to date, pretty much 99 to 100%, depending on the point in time, has been in private real estate. That 15% is a target of the trust. So we have the ability to flex up and down, which gives us some nice flexibility, which we'll get to later. And then as far as governance goes, we're uniquely set up to capitalize on some of these one-off opportunities that come up fairly quickly. Whereas I know many other pension plans have a board that they have to go to for investment approval. We have an internal investment committee, which is made up of the senior executives at the trust. They meet monthly, and then they can also meet on what we call a special IIC basis, which is for opportunities like these that need more timely, more quick turnarounds for investment approval.
Great. And you're both part of the Strategic Property REIT Execution and Delivery, or SPREAD team at TRS. Can you describe how you operate and the methods that you use for comparing public and private real estate?
Yeah, sure. We always have tried to monitor public REITs as many others do. And in 2022, I think we had seen that public REITs were selling off, and by October, the dislocation within the public REITs had become quite dramatic. And what we ultimately did was we assembled a 4-person team within our real estate team to tackle this. And we had some background beforehand, and ultimately we worked together. We assembled some internal models to address and articulate the opportunity. And in terms of how that team operated, we essentially met weekly to discuss any action items. And after we had our approvals in place, we designed those in a way to where there were parameters that we were able to execute within and take action. And if there was anything outside of those parameters, there was still an ability to take action, but we essentially went back to the team for approval. In terms of how did we go about comparing public and private real estate, on its face, it's very simple. When you get into actually working to try and articulate that, you get introduced to many of the complexities. And there's a lot of assumptions and decision points that you have to make. But at a very high level, essentially what we did was we priced the public markets and our private benchmark, Odyssey. And the way that we looked at that, we tried to boil it down into a cap rate valuation. And that is one area where you do run into some nuances, whether you're looking at a 12-month go forward NOI estimate to get to your cap rate, or if you have the last quarter of NOI that you're annualizing to try and equate the two. There are naturally some differences that exist and occur there. But at the end of the day, that was one piece, is how our public REITs priced, how our private REITs priced. And the other component of it is we essentially had to make an assumption about what was pricing normalization and how long it would take for pricing to normalize. And those were essentially all key components that were necessary and needed to ultimately get to an expected return that we could articulate. And in addition to that, a relative return, or spread, as the strategy is named, in terms of the expected return between the public REITs and the private benchmark.
And can you talk a little bit about how the SPREAD team collaborated and made decisions throughout that process of tactically investing in REITs?
Sure. As Jared said, we had a 4-person deal team. We met weekly. We had a live pricing model that was updated we reviewed it weekly. It was really updated real time on the cap rate spread between the private and public markets. When we were deploying the initial tranches of capital, and we had 400 million approved for the strategy by our investment committee, we were talking about a standard deviation of cap rates based on an historical period. Some of that methodology is detailed in the article that we wrote for PREA. But we had a number of different opinions and also different strengths within our team. One guy, Elliot Fry on our team, is very much a macro guy. Myself, I'm more micro oriented. There are some healthy debates on what ended up circling a lot around what the Fed was going to do in anticipation of Fed meetings, because as we learned quickly, those would move REIT pricing very sharply in a day even. So there was a number of different ways and conversations that we had throughout the process. At the end of the day, we did just a majority vote and whether we would deploy in any given week. And then when it came to realize the strategy, again, similar types of conversations around go forward returns and how that was comparing relative to the private markets. So when it came down to actually realizing the strategy, we looked at the opportunity cost of capital of continuing to hold our position versus if we ended up buying a property in the private markets, and determined that the risk of continuing to hold in the public markets was not worth it as far as the opportunities that we were seeing. And this was at a point when the spike in interest rates had really caused some interesting pricing to come about in the transaction markets.
And can you talk a little bit about how you went about sizing the position?
Yeah. So look, there were a variety of considerations. One of the primary ones was just working within our existing capital plan. And I think another, major one was at the time we were over our target allocation to real estate, the 15%. And so we really had to work to look at this from two different aspects. One was the relative opportunity set within real estate specifically. And then the other was essentially, what is the opportunity cost of the funding portfolio that is going to be sourced for the public REIT execution? And those were two of the major factors. I think another one that was at play as well is this was really the first time that we had internally executed this strategy. And so there was an element of proof of concept that I think factored into the decision about the sizing. And then really, I'd say the last one is that whenever you go into the public REIT, for us specifically, our benchmark is a private real estate benchmark, Odyssey. The public REIT pricing can obviously disconnect, and that dislocation or disconnection can become quite exacerbated over time. And where you see pricing and opportunity, it's not necessarily the end of that dislocation. And so you kind of have to go into this eyes wide open understanding dislocation may become wider, and you may have to endure what we essentially call noise volatility, which is the underlying fundamentals indicate one level of pricing, but in the near term, the pricing of the public REITs is going to be determined by the supply and demand. So you want to set this up in a way where you're able to sustain and endure that intermittent volatility, and it's aligned with your risk tolerance. So those were the four factors or main factors that sort of played a role in the decision on our sizing of opportunity.
Great. And can you talk about what you were facing in terms of market liquidity and execution issues as you made that $400 million commitment?
Yeah, I think this is perhaps a great benefit of TRS. We have an internalized trading team that is very familiar with index replication strategies and a variety of execution methods. And we worked in conjunction with them and collaborated to sort of examine ahead of time, what the depth of liquidity was within the public REIT markets. And ultimately, what came back was that liquidity was really not much of an issue at all. Essentially, since we were implementing this I guess we were actively investing, but in a passive index replication, we were allocating across the entire public REIT index. We were able to access that full depth of liquidity. And our understanding was that we could easily put 200 million into work in a single day in the public REITs and not really blink an eye. There was no expected impact at that level. Given our sizing of 400 million, the liquidity in the public REITs was really a non-issue for us.
And what sort of returns were you expecting as part of the spread strategy? And how do those returns compare to what you actually achieved?
Yeah, so it's interesting. Our modeling essentially suggested that there was a spread in return of approximately 30% when we looked at a 1-year go forward expected return in the public REITs and compared it to a 1-year go forward expected return in Odyssey. Now, there's a variety of factors that went into that buildup and that underwrite to an expected return, and those didn't all match perfectly, but the end result actually ended up being pretty closely aligned with what that underwrite was. In 2023, I believe the public REITs returned around 13%, while our benchmark Odyssey index return, I believe it was minus 12.7%. And the actual returns differ slightly because our first implementation began in December of 22, and our last realization occurred in January of 2024. And for our spread strategy, the over that period of time was 17.1%. So if you compare Odyssey at almost minus 13% and our IRR of 17.1%, ultimately it translated into over 3,000 basis points of alpha. So I'm not sure how well that answered the question, other than to say that our expected spread did happen to hit it on the nose with our initial underwrite, but it wasn't that we perfectly underwrote all the factors. The combination of how everything played out, the timing of our deployments into the public REITs happened to enhance our return. That's not necessarily how the strategy was designed, but we deployed capital initially in December, a majority of it in March, and for the last piece of it in October of 2023. And the timing of those deployments did help to enhance our returns beyond what the return was of the public REIT index.
Yeah, and to be specific, we ended up underestimating actual NOI growth from the real estate and overestimating the spread that public would come down to meet private. What happened was private cap rates almost entirely made up that spread by coming up to where the public markets were pricing at the time. But that was offset because there was fairly positive NOI growth across most sectors during our hold, whereas we underwrote 0% NOI growth at the time, seeing what we saw to be economic headwinds, which ends up actually not happening as much as we thought they would.
Great. And are there common challenges or hurdles that can make it difficult for investment committees to take action during public REIT dislocations?
Definitely. And we can really only speak to our committee, and I know many committees and pension funds and investors are set up differently from each other. But at the end of the day, a lot of it just depends on structure and how you're set up and how flexible that is. We're lucky enough to be fairly flexible. As I mentioned before, we have a target allocation for real estate of 15%, but that can flex, and that really is a long-term target. As Jared mentioned earlier, we were going into this investment at 17% of the trust. And so the real question was, you're putting another $400 million into real estate. That's going to take you higher when you should be trying to get lower. So we had to tease out the rationale for that and meet with our senior executives and committees for the justification for putting more money into REITs. One of their questions, which is one of the right questions to ask, is not just opportunity cost of public versus private real estate, but public real estate versus other sectors in public equities or other asset classes of the trust. Unlike most real estate investments, when it's relative to other real estate, we had to show what in essence was an opportunity cost versus the basket of assets that the trust would otherwise invest in, which was unique to this, something we weren't used to. The other big thing, which almost goes without saying, is timing based on how quickly the public markets move. Again, we actually wish we could have done it a month prior because pricing was even more attractive, but we were able to get this kind of from initial underwriting to final approval in, I believe, less than 2 months, which, in speaking to some of our peers, is fairly unique. And in other cases, it takes 3 to 6 months, if not potentially longer, for a new strategy like this. And then the final thing, which I think is quite important to articulate, is we had a underwritten return for this. And that's important to demonstrate to your investment committees that you can compare it relative to other real estate transactions or other strategies. Everything we present to our committee has a number on the page. And if we were going into this and just saying public REITs are cheap, then the question is how cheap? Well, really cheap. What are you really getting at? So you need to have a number on the page and a model. And even though we know that model is going to be wrong, that methodology and really framework has to be there in order to articulate what, at the end of the day, is quite a simple passive strategy. But there are numerous assumptions and factors that you do have to model.
Yeah, I think that's right. So ultimately, at the end of the day, you need to be able to articulate an expected return. Essentially, that's what comes with virtually any other underwrite in real estate. And so if you don't have that, I think the conversation becomes a bit more obscure and it's harder to really nail down. And if you at least have that, you can debate the merits of what the assumptions are, but it gives you a framework and a starting place to size the opportunity and discuss it from there.
And as you look ahead, are there ways in which you might replicate, modify, or improve the strategy that you've used for the next round?
Yeah, look, one of the great benefits of having gone through this, that the plumbing is in place now, and the setup time that's involved with that going forward, we're sort of already there. And I think a lot of times it's hard to do things like that until the opportunity comes along, and then there's a motivation because there's an action event right in front of you. But really working to have that plumbing in place, I imagine for most, save a large amount of time in the future. And it also sets things up to where we're ready on any given day to articulate the opportunity. We have live updated expected returns. That's what's great about what's already there, and it's going to be a benefit going forward. In terms of additions, I think there's always the opportunity for improvement, their assumptions or how the model is constructed. You always need to look at that and see if there are ways to refine it or make it better. Essentially, those improvements can be ongoing. Potential like expanded applications. I think, one of the things that is worth spending more time on, certainly not the only thing, but one of the potential opportunities is to look at more property type specific dislocations. I think we're aware and understand that the dislocations that occur in the public markets, many times it is broad pricing discrepancy between public and private, but it's not always the case. And to the extent there are deeper pricing dislocations within specific property types, that could be something interesting to really spend more time on and see if there are opportunities to expand on the opportunity set.
Great. And putting all this information together, what would you say are some of the main takeaways and lessons learned from this experience?
Yeah, and we've touched on a number of them. Just to reiterate, having an underwritten return, an objective, and even a time period for that underwritten return is quite important, with knowing that you have to have the flexibility to hold longer. We didn't know when this spread between public and private would close, so we were prepared to hold longer than the 1 year hold that we ended up doing on average. A couple other things. I think it's interesting the way we're set up in the sense that we're primarily involved in the private markets and the transaction markets day to day rather than public markets. I know a number of our peers do have dedicated public REIT traders or investors, and that comes with advantages as well. But I think uniquely from our seat, we could really compare public real estate to private real estate real time based on what we're seeing in the transaction markets. I guess the other thing I'd say there is don't overcomplicate it, because we could speak in circles and we could debate going in and out of different property types. And after we realized the strategy and people learned about it, we had a number of inquiries from public REIT managers saying, we can do this by picking individual stocks. We have this complex methodology. At the end of the day, when there's a dislocation like this, we estimate ballpark 80% of your return and your objective can be achieved just by going into the index like we did rather than trying to pick individual stocks or sectors. And so if we spent more time to create a more complex methodology and trying to pick individual stocks or sectors, then the timing itself would wash out really the bulk of the opportunity. So those are two things, Jared.
Yeah, I would say, look, when public markets are dislocated, public REITs are dislocated, the potential for alpha, I think, is greater and enhanced in that environment. And the ability to produce enhanced alpha through security selection, I do think is greater during those moments. But to Brendan's point, when the dislocation is large enough between public and private markets, that is essentially the lion's share of the opportunity. And one thing you always have to keep in mind too is that when that pricing normalizes, actual pricing dislocation or alpha opportunities within the security selection, the normalization of that pricing may not be aligned entirely with the normalization of pricing between the broader public and private REITs as a whole. Maybe another thing that Brendan touched on a little bit is defining margin of safety. You can look at this and say, hey, if there's a 5% discount, we're really interested in trying to capture that. The potential benefit versus the volatility that may ensue in trying to capture that. The juice may not be worth the squeeze for some, it may for others. When we went through this, and this isn't a perfect number, but when we were looking at margin of safety, we essentially agreed on 20% And I think as we keyed in on earlier, where we actually took action on this, I think that spread was in excess of 30%. And the main point about that is nobody's ever going to get everything right. We all have to make assumptions, and some of those are going to be correct. Some of those are going to be incorrect. There will always be some element of what you don't know. But if your margin of safety is high enough, you're more than covered for those things if it's wide enough. And I think the other piece of it too is even if you are right on everything else, you do have to essentially wear the intermittent noise volatility within the public markets, because I think it's very difficult to really predict and know and understand what the supply demand imbalance in the near term is going to ultimately be. So 20% was our level for that. And that's not to say that it doesn't make sense if the margin of safety is smaller. But for our first time going through this, we essentially waited for one that was quite large, and we're ecstatic that it worked out incredibly well. And I think everybody learned a lot through this, and we're very happy to have the sort of tools that have been built that we can utilize going forward. So maybe just a couple other comments on it. I can't really speak highly enough of the collaboration that took place within the 4-person team as we went through this process, and really the broader team and the trust and embracing this as we set about to do this. And I think it's really helpful to have a variety of opinions. I think it helps to make everyone sharper when you know that your opinions can be challenged. And maybe one more point to that is it's also good to have a baseline that everyone can point to when you have different opinions. So it's been a great collaboration within our team here, and we're very happy with the results.
Great. Brendan, Jared, thank you so much for spending this time with the podcast today.
Thank you.
Very much a pleasure. Thank you.
And to our listeners, if you enjoyed this episode, please leave a review or subscribe on your favorite podcast platform.